This is the 8-step process of the accounting cycle for a sole proprietorship. First, we have to analyze transactions that we get. For example, the one on the far left is what's called an income statement. Now, this one is one that the company received, the restaurant received from a company, and it just says that we received the shipment, but we still have to pay for it yet. And then next we'd have to go journalize it in our journal, and it would go under what's called an accounts payable. Then next to that you put in the name of the company, and the name of this company that I chose to use was Lay's of Chelsea. And then you'd have to post how much the income statement was worth, which was $750, and you put it in your what's called the general debit because the company has lost money for the shipment, as well as the cash credit because we still have to pay for it in advance. And then after that we'd have to post it to the general ledger. Now, what the general ledger is just a separate list of all the accounts individually, so you can look specifically at like the sales account or the accounts payable account. And then after that you'd have to create a worksheet, which just helps you figure out what's in the company. So you put in adjustments for, say, if you use some of your supplies, we have to know how much your supplies is left. So we had $480 of supplies to start with, then we used $200 of those supplies. So we have to post that somewhere, and we'd put that in the worksheet. Next, we have to journalize and post those adjusting entries. So to start the month, we had $480 of supplies. We used $200 of those supplies, which gives us $280 left. So we post that into the general ledger as well as the journal itself. After that, we have to prepare financial statements of the income statement as well as the balance sheet. Now, the income statement just measures your revenues, your expenses, and figures out whether or not you're making a profit or a loss. And your balance sheet measures your assets, your liabilities, and your owner's equity, figuring out how much your company is worth. Now, the big thing here is that both your assets have to equal out your liabilities and owner's equity. If they do not equal out, something went wrong somewhere. Then after that, you have to journalize and post your closing entries, which would happen at the end of a month or an accounting cycle. Now, you'd only close the temporary accounts such as your expenses, your sales, and accounts payable if you have, finish those out at the end of the month. And you'd have to journalize all that, and you summarize how much like your revenue is worth or your expenses are worth, and put it under what's called an income summary, which would then also go into your general ledger. And you have to make sure that in your general ledger all your temporary accounts are zeroed out at the end of the month, because if they aren't, again, something went wrong somewhere. And then finally you'd have to prepare what's called a post-closing trial balance. Now this again measures your permanent accounts that you still have rolling at the end of the month, figure out how much is left, and it measures like cash, supplies, and capital. And again, both those debits and credits have to equal out, because if they don't, again, you messed up somewhere, and you have to make sure they're equal, otherwise you have to go back and fix something. So thank you for watching the 8-step process of the accounting cycle for a sole proprietorship.